It's tax planning. It's tax planning, right? So, what is tax planning? Most of us tend to think of tax planning as investing to save tax. So, let me first start by telling you tax planning should ideally be a part of your financial planning process, and it should not be just and just to save taxes. And unfortunately or fortunately, uh, government has introduced and has been constantly introducing measures. So there is only so much that you can actually do, whatever we try, and everything, every transactions which we are doing these days are being tracked by, there's something called as annual information statement in your income tax portal. When you log in with your PAN number, there already is something called as annual information statement where all your transaction history is already pre-captured, be it your salary, be it your investment in mutual funds, be it your investment in stocks, whatever it is pre-captured, right? So there is not much that you can do with regards to saving taxes, but there are a few sections where one could save taxes. That's what we are going to be talking about today. So firstly, we are going to be talking about old versus new. How do you decide which one is beneficial for you? Second, the sections, the biggest section, of course, under which one can save taxes is section 80C. So we're going to be talking about the various products available under 80C, which is the most or the better product to invest into under section 80C. And then we'll also talk a bit about other sections where you can save taxes and your home loan related section, which is again a big chunk where there is a tax deduction under. So we'll talk about this, and last but not the least, we will talk about some financial actions which you have to complete by December 31st. So without wasting more time, I'll first talk about how various incomes are taxed, and then we'll go on to seeing which tax regime works better, and then we'll go on to seeing the various sections. So quickly, salary, we all know, is taxed as per our tax slab. Any income which you receive as interest on your fixed deposit savings bank account is taxable. Fixed deposit interest is completely taxable. Savings bank account interest up to 10,000 rupees is not taxable. Beyond 10,000, if you receive any interest in a year, it is taxable as per your tax slab. Now, dividends, any dividend which you receive from mutual fund companies, shares, etc., is completely taxable as per your tax slab. So all of these incomes have to be added. When you file your income tax returns, other than income from salary, you are supposed to declare income from interest, income from dividends, income from rent. All of these need to be declared as income from other sources, and you need to pay tax on them accordingly. Now, for gifts, very few, very closest relatives like your parents, spouse, siblings, and your siblings of parents are considered as the closest circle. Now, any gift which you receive from them is completely tax-free. Other than that, if you're receiving any gift from, say, employer, friends, or any other relatives, that is completely taxable on other. Okay, see, if you're receiving these gifts for your marriage or for some special occasions, then it is again tax exempt. But if you're receiving it, uh, for no reason, no particular one of the not one of those special occasions mentioned, then up to 50,000 rupees is still tax free. So, for example, your friend gifted you 10,000 rupees, your employer gifted you 35,000 rupees. So, the total in a year that you have got as gift is only 45,000. So it is still tax exempt. But as soon as this total tax amount in a year exceeds 50,000 rupees, then it is going to be, the remaining amount is going to be taxable as per your tax slab. And also please remember, any gift which you have received, even though it may be tax complete, it could be from your parents or your spouse, which is completely tax exempt, right? But still, do mention it. There is a separate schedule called EI, that is exempt income. In the income tax return forms, there is a schedule called as Schedule EI. So declare these gifts over there, and then automatically whatever comes in exempt income there will be no tax calculated on that. So do declare that. Now, what about your other investments which you make? See, you might have invested in FD or stocks. So FD ka to, and any interest which comes in is completely taxable. If you have invested in stocks, we'll talk about it later. If you have invested in mutual funds, for example, there are different types of mutual funds: debt, equity, hybrid. So we'll talk about all of those. But if you have invested in any bonds, like your RBI floating rate bonds, that is completely interest which you receive is completely taxable. Now, if you have invested in non-convertible debentures, P2P invoice, P2P, sorry, invoice discounting. So all of these are completely taxable as per your tax lab. Within mutual funds, there are three categories: equity, debt, and hybrid. Now, in debt mutual funds, unfortunately, recently, that is in budget 2023, in February, it was announced that from 1st April 2023, the taxation on debt funds is that whenever you withdraw, see, any investment in mutual funds is not taxable. But when you withdraw from the mutual fund, any gains which you have made, these are called capital gains. Okay. So suppose I invested 10,000. When I withdrew, the money had grown to 50,000. So my gains is 50 minus 10, that is 40,000. That's my capital gain. Now on my capital gains, if I have invested in a debt fund, I have to pay tax as per my tax slab. Completely taxable, exactly like in an FD interest. Your capital gains from debt funds are also fully taxable. When it comes to equity mutual funds, or if you have invested directly in some stocks or shares, how are they taxed? If you buy and sell these stocks within a year, I mean, if you're selling it within a year of buying it, then the gains are called as short-term capital gains. So short-term capital gains will be taxed at 15%. Now, if you have sold, if you're selling this after a year of purchase, that means these are considered as long-term capital gains. So when you're held it for more than 1 year, your gains up to 1 lakh are not taxable. Only if your gains in a year is above 1 lakh, then you are taxed on it at the rate of 10%. So that is why equities tend to give you the best taxation, because even if your gains exceed 1 lakh, you are being taxed on the gains at only 10%. Now, if you have invested in shares, but you're doing intraday trading, then it is completely taxable as per your tax slab. If you are doing options, derivative, futures, so these are also completely taxable as per your tax slab. So any trading that you do, futures, options, stock trading, intraday trading, is taxed as per your tax slab. Shares, if you have invested in foreign stocks, that is companies which are not listed on the Indian Stock Exchange. If you are holding such stocks, then these are taxed at, if you're selling it before 2 years, it's considered as short term. If you're selling it after 2 years, it's considered as long-term capital gains. So if you're selling it before 2 years, that is less than 2 years time, then short-term capital gains as per your tax slab. Okay. And the dividends also which you receive will be completely taxable as per your tax slab. But if you're selling it after 2 years, then you need to pay tax on it at the rate of 20%. But there is an indexation benefit available. Now, what is this indexation benefit? I will explain it when I talk about property. I'll give you an example and talk about, say, property, and explain how indexation benefit works. Indexation benefit basically is accounting for inflation. So, suppose I bought a flat in, or suppose I bought a foreign share in 1990, and now I'm selling it in 2015 or 2023. It's been so long. Now, I might have bought it at 100 rupees, but when I'm selling it now, the rate might be equal to, say, a lakh, right? So because of inflation, in so many years, the inflation has gone up really high. So it is unfair to be saying that 1 lakh minus 100, that is on 99,900 rupees, you pay tax at 20%. So to account for inflation, what the government has done is it has allowed something called as indexation benefit. I'll tell you how to calculate that also. Just give me 5 minutes time. So before that, let's look at insurance policies. Now, any ULIP policy which you hold, if the premiums for that in a year, cumulative premium, suppose I hold 3 ULIP policies and totally I pay 3 lakhs, 1 lakh each as the premium for these policies, then the total is 3 lakhs. In that case, my maturity benefit is going to be taxable as an equity mutual fund itself. But if my total premiums are less than 2.5 lakhs in a financial year, then my maturity amount in a ULIP is tax exempt, tax free. Similarly, in case of an endowment policy, if the total premiums I pay is more than 5 lakhs, then the maturity is going to be taxable as per my tax lab. But if the total premiums which I pay is less than 5 lakh, then I will be paying tax on it. I will be paying, if the total premium is less than 5 lakhs, then I'll be paying nil taxes on the maturity amount. When it comes to gold, uh, holding period is basically 3 years when I'm talking about a gold jewelry, physical jewelry, etc. Then the holding period is 3 years, which means if I sell before 3 years, it's a short-term capital gain. If I sell it after 3 years, long-term. Now, before 3 years, if I sell it, I'm taxed on it as per my tax slab. If I sell my gold after 3 years, then I get 20%. I pay tax at 20%, but I do have the indexation benefit available. Unfortunately, gold exchange traded funds, these are a form of mutual fund scheme where you're buying and selling units of gold on the stock exchange. So gold ETF earlier used to enjoy a good taxation, but now if you have invested in a gold ETF, it is completely, the gains are, you have to pay tax on the gains as per your tax lab. It's fully taxable basically. There's one good scheme. When you're investing in gold, a better option is to invest via a sovereign gold bond scheme. Now, why? It is because in a sovereign gold bond scheme, if you hold it till maturity, so the maturity of the scheme is 8 years. If you hold till maturity, then the returns which you get at the end of 8 years is completely tax-free. But every year, an 2.5% interest is declared on the sovereign gold bond scheme, and that interest is completely taxable as per your tax slab. So, coming on to property. Before I talk about physical property, just one word, there are these schemes called as fractional property these days, right? So when you are investing in a fractional property, you are actually investing in a, it's not physical property which you are investing into. When you are investing in a fractional property, the underlying asset could either be equity or debt. Now, if the underlying asset of your fractional property is debt, then you pay, the taxation follows as per the debentures or the debt taxation. If you are invested in an equity, if the underlying asset is equity, then you follow the unlisted equity taxation. That is 2 years, less than 2 years, more than 2 years taxation. When it comes to physical property, property in the form of houses or land, how that works is, if you sell property before 2 years, then you're taxed on the gains as per your tax slab. If you sell it after 2 years, then you pay tax on the gains at 20% with indexation benefit available. Now, what is this indexation benefit? Like I spoke to you already, it accounts for inflation. So how do you calculate that? There is something called as CII, Cost Inflation Index. Every year, the government comes out with a cost inflation index. So CII of the selling year divided by the CII of the buying year. Okay. Sale year CII divided by buying year CII. You'll get a number. That number, you multiply it with the cost at which you have purchased. So the price that you get after multiplying the inflation index, that is CII of sale year divided by CII of purchase year, will give you the cost of acquisition. So it will be an inflated amount. So suppose I bought a property at 20 lakhs. CII of the year in which I sell divided by CII of the year in which I buy, suppose it ends up to be 1.5. So I multiply 20 lakhs at which I purchased my property into 1.5. So the cost becomes 30 lakhs instead of 20, right? So if suppose I've sold it at 70 now. So instead of paying tax on 70 minus 20, that is on 50 lakhs, I end up paying tax only on 70 minus 30, that is on 40 lakhs. So that's how your indexation benefit works and how it benefits you. So that's on your physical property. Now, cryptocurrencies, I don't want to talk much or spend more time on this slide because number one, we don't recommend investing in cryptocurrencies at all. Government also does not believe so, since it's an unregulated instrument, and which is why the taxation on cryptocurrencies is that whenever you buy it, whenever you sell it, irrespective of the holding period, you pay tax at flat 30%. Even if you fall under the 10% tax slab, you pay tax on crypto gains at the rate of 30%. Right. So, irrespective of your tax slab, you are paying a high amount of tax if you have invested in cryptos, because number one, the government wants you to stay away from this scheme. So that's on how your various incomes are taxed. Now, before we move on to the various sections under which one can save taxes, just one small word. I will share across a handbook which will have key slides from this presentation. It will be shared with you all by your coordinators. We will also be sharing an Excel calculator, which will help you decide whether you wish to be under the old tax regime or the new tax regime. Okay. How this calculator works is, towards the end of the session, if I have time, I'll take out 2 minutes and show the calculator to you. What you have to do is very simple. The cells where you can enter numbers is marked in a color. So you have to enter only there. You need to enter your salary, your other income which you have from, say, bonus, joining bonus, interest, dividends, everything you have to enter. Once you enter that, you need to enter your allowances like HRA, LTA, etc. Then you need to enter the deductions which you have. Suppose ATC, ATD, whatever deductions you have, you enter it. And the calculator will throw up an amount of tax which you need to pay under the old tax regime, and what tax you would be paying if you opt for new tax regime. So seeing the numbers, it will become easier for you to decide which tax regime will work better for you, and you can choose accordingly. So moving on, how do you decide which regime to be under? Number one is use the calculator. It will help you decide. Number two, the old tax regime has deductions allowed. See, the slabs in the old tax regime are higher. So the amount of taxes for a certain slab up to 5 lakhs, you pay nil tax. After that, you pay 5%, and then the slab directly jumps to 20%. Whereas in a new tax regime, you have 5%, 10%, 15%. So the increase is gradual. So the tax slabs are more attractive under the new tax regime, but there are no deductions allowed under the new tax regime. Whereas if you opt for old tax regime, there are a whole lot of sections where one can save taxes. So this is the primary difference between old and new. Now, your organization will most likely open up the window where you can choose the tax regime only once in a year. And most likely it will be in April. Please check with your HR. At that time, you are supposed to declare whether you wish to be under the old or the new tax regime. However, suppose you declared that you want to be under the new tax regime, but now after seeing this calculator, you change your mind, you want to be in the old tax regime. It's possible. What you can do is, though your organization may not allow you to change, while filing your income tax returns in July, that time you can still change your income tax, the tax regime which you have chosen. Similarly, suppose last year you chose old, this year you want to move to new, or vice versa, can be done, no problem, provided you are only a salaried employee. I mean, you can have salary income, you can have dividend income, interest income, rental income, everything allowed. But the moment you have business income, or you are dealing in FNO, intraday trading, etc., these are considered as speculative income. So as soon as you have business income or speculative income, then you will not be allowed to change tax regimes year on year. You can change it only once in your entire lifetime. Right? So that's on changing tax regimes. But also, please do understand, if you are opting for new tax regime, there is one more thing which you have to keep in mind, that is, you cannot file belated returns. So suppose people who have missed filing ITR before 31st of July 2023, 31st July was the deadline, right, for filing taxes for financial year 22-23. So if you have missed that deadline and you want to file the ITR now, you have to compulsorily opt for old tax regime. So new tax regime does not allow belated filing of ITR, right? And also set off and carry forward of losses is not possible if you're filing belated returns. So please do keep these things in mind. Now, like I said, I want People should not invest into tax saving instruments just for the sake of tax saving. It should be a part of your financial planning. The financial planning process basically involves, you know, sitting down, understanding your current financial situation, understanding what amount of risk you can take, what are your various goals, how far away are your goals, accordingly choose the products, um, have a proper diversification, don't put all your eggs in one basket, and then accordingly choose the products and invest, not just to get tax saving. Now, when your company asks you, this must be the season, I think by December end or Jan, sometime your company will ask you to declare the proofs of your various investments, right? So uh, try to give your proofs on time. What are your proofs? Basically, if you're claiming HRA, then your rent receipts. If you're claiming LTA, your travel proof. If you're claiming ATC benefits, then wherever you have invested under ATC, the receipt for that, the proof. So if it's a mutual fund scheme, it's the folio details. If it is a premium which you have paid, then the premium receipt. So such proof you need to provide to your employer. If not, what happens? In the last 3 months till now, they would have deducted taxes based on what you have declared, saying I am going to invest 1.5 under ATC, or I am investing say 20,000 as health insurance premiums. You might have declared all this and your company is accordingly calculating tax and deducting till date. Now, these proofs, if you don't provide to them, then Jan, Feb, March, you will end up paying higher taxes because they will assume that whatever you had declared was incorrect. You have not actually invested in those places. And hence, for the remaining 3 months of the financial year, tax at a higher rate will be deducted. So that's the importance of providing the investment proofs on time. Now, what are the investment sections under which, if you are opting for old tax regime, like I said, new tax regime allows only one deduction, that is NPS. That too, if your company is providing it under section 80 CCD 2. Otherwise, no other deductions are possible under the new tax regime. So now I'm going to be talking about the old tax regime. What are the various sections and how much can you save? Now, the biggest section is section 80C. The total one can save under section 80C is 1.5 lakhs. This includes your EPF, VPF, etc. So there are two categories to it. First is your fixed return products. Some products are market linked returns. So what are these fixed return products? First is your EPF, Employee Provident Fund, which is getting deducted from your salary. 12% of your basic is getting cut, and that qualifies for a tax exemption under section 80C. Now, if your EPF is not covering the entire 1.5 lakh, suppose your EPF is only say 50,000, you still have another 1 lakh where you can invest under section 80C. So what are the various options possible where you could invest? You have post office schemes like your National Savings Certificate. You have tax saving FDs by the post office. You also have two good schemes. One is Public Provident Fund. This is again a post office scheme, but you can open it in any bank or any post office. What is the scheme? It comes with a 15-year lock-in. Minimum amount that you can invest in a year is 500. Maximum one can invest in a year is 1.5 lakhs. Now, the current rate of return on this scheme is 7.1%, but the returns are completely tax-free. So after 15 years, whatever maturity amount you get is completely tax-free. So which is why it's a good scheme to be in, because 7.1 guaranteed returns, completely tax-free returns. Now, the other good scheme, fixed return scheme, which you can invest into is Sukanya Samriddhi Yojana, but this is for people who are having a girl child under the age of 10. So in a girl child's name, you can invest. The girl child must be less than the age of 10. The maturity of this scheme is 21 years. And again, a good scheme to be in because the returns from the scheme are completely tax-free. Currently, I think the rates have increased to 8% now. But so these are the fixed return products one can invest into under section 80C. Now, there are also some products which don't give you fixed returns. What are these? Your life insurance policies, like your endowment policies, ULIPs, the premiums which you pay on these also qualify for Section 80C benefit. Sorry. Also, there is a mutual fund scheme called ELSS mutual fund. So all these are market linked products, which means the returns from these schemes are not fixed or guaranteed. So your insurance policies, like your endowment, ULIP and all, the premiums which you pay on these are qualifying for deduction under Section 80C, but the returns from these schemes are very, very low. Technically, 3 to 4% is the post-tax returns that you get. It's very low. Hence, it's recommended not to invest in these products, right? But however, if you have invested, the premiums which you pay on these can be claimed as a deduction under Section 80C. And please remember, these policies need to be active for at least 2 years in case of endowment and 5 years in case of ULIP policies to be able to. So even if not, if you withdrew from that before 5 years, suppose you have a ULIP and you withdrew from that before 5 years, the tax benefit which you claimed in the past years when you had invested will get reversed. So that's what you need to keep in mind. Now, there is also one mutual fund scheme which qualifies for tax exemption under Section 80C. Now, what is a mutual fund basically? You invest your money into a mutual fund scheme. Now, when I'm talking about ELSS, it's an equity mutual fund scheme. So whatever money you are investing in this gets invested by the fund manager into various stocks or shares. Now, since the investment is being made into stocks or shares, it is recommended that you stay invested for a longer time horizon. Though the lock-in period is only 3 years, it's recommended you stay invested in it for at least 7 years. And also, the risk appetite needs to be a little higher when you are investing in an ELSS mutual fund, because at the end of the day, your money is getting invested in the stock market. So there is an amount of risk involved in it. So if you can take on that high, a little amount of risk, then ELSS mutual fund is a very good scheme to be under. Lock-in period is 3 years. You can invest either lump sum amounts or you can invest systematically month on month or quarter on quarter. However you wish to, you can invest, but 3 years is the lock-in period, which means if I'm doing a systematic investment and my last installment went in December 2023, then that installment amount I can withdraw only in December 2026 after 3 years of that installment. So each installment needs to complete 3 years if you're investing via a systematic plan. Now, for you to be able to choose mutual fund schemes, the ELSS mutual fund, which scheme do I choose? We do have unbiased recommendations on the Mint 20 schemes and the Money Control 30 funds also on our website and on Morningstar. So these 4 places are recommended to choose schemes since they are ranked purely based on quantitative analysis. Now, of course, ELSS mutual funds have given the best returns among the various ATC instruments. But again, like I said, it involves risk. So based on your risk appetite, what you can do is choose a combination of one risky, one non-risky. The best combination possible would be PPF plus ELSS mutual fund when you are looking at Section 80C benefits, right? Now, other than this, people who have not invested in none of these, the tuition fees which you're paying for your child's education can also be claimed as a deduction under Section 80C. Also, stamp duty and registration. If you have taken a house and you have paid the stamp duty and registration in this financial year, that also comes under Section 80C. And if you have a home loan, the principal which you pay on your home loan also falls under Section 80C. So these are the various options under which one can invest to claim tax benefit under Section 80C. And the total one can claim under Section 80C is 1.5 lakhs. Now moving on, we have NPS. It's called National Pension System. It is a scheme meant for retirement. Now, there are 2 ways in which one can invest, either as an individual or through your employer. So if your employer is providing you this NPS option, then you can invest in it through your employer also. If not, you can invest in it as an individual separately. So if I'm investing as an individual, the maximum I can claim tax benefit is for 50,000 rupees. If I'm investing via my employer, then 10% of the basic is what I can maximum claim tax benefit on. But ATC plus 10% of my basic maximum can be 2 lakhs, right? So which means if my ATC I have exhausted only 1 lakh, then I can have 10% of my basic. If it works out to be 1 lakh, I can still have both 1 lakh under ATC and 1 lakh under corporate NPS 80CCD 1. Together it is 2 lakhs. So that's the maximum I can claim. Now, how does this scheme work? Minimum I need to pay is 1,000 rupees in a year to keep my account active. This scheme is locked in till the age of 60 because it's a retirement scheme. So once I start investing, I cannot withdraw my money till I become 60. Even if I retire at 55, I can withdraw only when I turn 60. At the age of 60, 60% of the corpus can be taken out tax-free. Now, this 60% need not be taken out as a lump sum. You can take it out in installments up to the age of 75. And the entire will be tax-free. Each of your installment will be tax-free. But that's 60% of your corpus. The remaining 40% is invested into annuities. And that comes to you in the form of pension. And that pension is taxable. So the 40% component is taxable. The remaining 60% can be withdrawn tax-free. Why this is a better scheme is because the money which you invest into NPS is being allocated between 4 asset classes: equities, debt, government bonds, and corporate bonds. Now, if you don't know how much to invest into what, see, a better option would be to take higher exposure to equity. Since you're anyway staying invested for long term, the volatility in equities reduces in the long term. So better option would be to go aggressive and opt for higher allocation to equities. Go for an active choice and take higher allocation to equity. But if you don't know how to manage this, what you can do is opt for an auto choice option. Under auto choice, based on your age, automatically funds will get allocated across the various sectors in a predetermined manner. Now, other than ATC and ATCCD, there are few small sections where one can save tax. One is ATD, which is your health insurance premium. Not applicable for medical checkup, or if you have got admitted in the hospital and you have some hospital bills, you cannot claim it. Health insurance premiums which you are paying can be claimed under section 80D. Maximum one can claim is 25,000 if you are less than 60. Suppose you're paying for your parents also and for yourself, and your parents are above the age of 60, then for their premiums, you can claim 50,000, for yourself, 25. So totally 75 you can claim. 75,000 is the max that you can claim. People having education loan, the interest on your education loan is completely, can be claimed as a deduction, complete amount. There is no higher ceiling on that. Under section 80E. Now, there is no higher ceiling. Suppose my interest in a year on my education loan is 4 lakhs. I can claim the entire 4 lakhs, but I can claim maximum for 8 years only. So, highly recommended if you're having an education loan running, try to finish it within 8 years. Now, on your donations, whatever you're donating to any charitable organization or to a political organization, each of these charitable institutes have to get registered. So all of them will be having a lot of paperwork which they have done already. Okay. Now, sorry. Yeah, so these organizations have done a lot of paperwork to be able to qualify as a charitable organization. Now, whatever you donate is not completely tax exempt. Some charitable institutions qualify for 100% tax exemption, in which case whatever you donate is completely tax free. For example, a Prime Minister's Relief Fund or a Chief Minister's Relief Fund. But certain organizations qualify only for 50%. So best option would be to ask the charitable organization itself, please show your certificate and please let us know what is the tax deduction that you are eligible for. That's the best way to understand. Now, the next section is section 80 TTA. Remember, I told you savings bank account interest up to 10,000 rupees is tax exempt. So on your savings bank account, if you have got 5,000 rupees only as interest in a whole year, then that entire 5,000 can be claimed under section 80 TTA. But if it is more than 10,000, Suppose I got 15,000 rupees as interest on my savings bank account in this year. So 10,000 is tax exempt under section 80 TTA, and on the remaining 5,000 I have to pay tax as per my tax law. Now the biggest section is your home loan. Now home loan, like I said, two components. Principal which you pay on your home loan, section 80C. The interest which you pay on your home loan can be claimed under section 24. Now the maximum amount you can claim is 2 lakhs. Maximum number of home loans that you can have is 2. So suppose I have 2 home loans. The total of interest of both the loans, what I can claim is 2 lakhs. The next criteria is my construction of my house should have been complete. If my house is still under construction, I may still be paying the EMIs, but I cannot start claiming the interest benefit on it. Only once the construction is complete can I start claiming the interest. Now, once I start claiming the interest, if I have some backlog interest which I have paid, which you call pre-EMI, right? So if you have paid interest already when the construction was not completed, what you can do is you can claim it in 5 equal installments. But the crux here is the total amount that you can still claim is only 2 lakhs. So suppose this year's interest I am paying 1 lakh. And in the backlog, in the time when my construction was not yet completed, I've paid 5 lakhs totally. So I can divide it into 5 equal installments. That is 1 lakh. So this year's 1 lakh and previous year's ka backlog 1 lakh. Totally put together 2 lakhs I can claim. Right? So that's on your home loan. Remember, if 2 people have taken a home loan together, for both of you to be able to claim the tax benefits, number one is you can claim in the proportion in which you're paying. So suppose I pay 1 lakh, my spouse pays 1 lakh, both of us can claim 1 lakh each. So how do you do it? Most people will ask a question saying the EMI goes only from one account. How can we both be paying? What you can do is you can have a trail proving that, though 2 lakhs of EMI is going from my account, my husband is say transferring every month 1 lakh to me, which is his share of the EMI. So just have that trail in the background so that in case there's an inquiry, you have the proof enough to say that you are also contributing. Now, the second criteria is whoever 2 people are claiming the home loan, it's not enough if you're just co-borrowers. You have to be co-owners in the house as well. So suppose the house is in just my name, but the loan I have taken in mine and my husband's name, my husband cannot claim the tax benefit because the house is only in my name, right? So the house also needs to be in both names. Loan also needs to be in both names. So that's the criteria required for claiming tax benefits. Now, these are the sections under which one can save taxes. Last but not the least, 2 allowances which most of us have. One is HRA, one is LTA. What is HRA? House rent allowance. On the house in which you are staying on rent, you can claim HRA. Your company gives you an amount as HRA. Is that complete amount tax exempt? No. There's a criteria. What is that? So suppose my basic is 27,000. Suppose the HRA which I get from my company is 15,000. And the actual rent which I pay is say 15,000. Now, how would the criteria will be calculated is actual HRA which you receive is one of the conditions. The actual rent which you pay minus 10% of your basic. So suppose I'm in this situation when I said I'm paying 15,000 as rent and 10% of my basic works out to be 2,500. So 15 minus 2,500, that is 12,300. Now the third criteria is, so for those of you who are in, I saw most of you are from Bangalore, some of you are from Mumbai. So Mumbai is a metro. Mumbai, Delhi, Kolkata, Chennai. These 4, if you're staying in these 4 cities, then 50% of your basic. If any other city, then 40% of your basic, whatever that amount is. So whatever is the lowest, actual rent paid minus 10% of basic, actual HRA which you get, and 40 or 50% of your basic. Among these 3 criteria, whichever is the lowest, that is the amount on which you can claim tax exemption on your HRA and on the remaining amount. So 15,000 is what I get as HRA in this example. Whereas the lowest among these 3 is 12,300. So on the remaining 2,700 rupees, which I get as HRA, I need to pay taxes as per my tax slab. So that's how HRA works. For questions as to, I have a home loan also and I have HRA also, I'm staying on rent also, can I claim both? Yes. If you're staying on rent, you claim HRA. If you have a home loan somewhere else or within the same city also, but you're not staying there, you can claim loan benefits also on that. That's not a problem. Just keep in mind, have proper rental agreement, have rent receipts, ask your landlord to provide his PAN number, if not, at least a Form 60 declaration. Um, Suppose you're staying with your parents and want to claim HRA, have a proper rental agreement between yourself and your parents. Pay rent on time to your parents, and whatever rent you are paying is income from house property for them. So when they are filing their income tax returns, they are supposed to show your rent which you are giving as income from house property and file their income tax returns accordingly. Now, one more allowance which most of you might be getting, I'm not sure, is a leave travel allowance. This is the general rule which income tax department says, but each company will have its own rules and regulations also. So please do check with your HR. So twice in a block of 4 calendar years, you can claim leave travel allowance. That is only and only for travel, not for sightseeing, not for food, not for accommodation. Only and only travel, that to domestic within India only. And it's only for yourself, spouse, children, and your parents. If you can provide the proofs of your travel and claim the deduction on LTA. But like I said, please do check with your HR. There might be some other conditions also which you have to fulfill. Like some companies I know ask for minimum of 10 days leave that you have taken to be able to claim the HRA benefit, right? So such permutation combination, whatever is there, the other rules, please do check with your HR. Uh, we do have when I was talking about the income tax calculator, right? We do have a small portal which we have developed. Uh, Shweta, have you dropped the link to the portal on the chat box?
Yes, ma'am.
Yeah. So I'll again, Shweta, if you can just please drop the link again. This is a small portal which we have developed. You have 1 month complimentary access to this portal. This portal has some calculators and the old versus new tax regime calculator, which I spoke to you about, is also part of this portal. So please do access it to get advantage of this calculator as well as some other calculators available. You also have videos on some topics related to personal finance. So, for example, life insurance, there are some videos which talk about life insurance, some videos which talk about general insurance. So, it's a repository of information for you basically, and we are giving you complimentary access for just 1 month. So, please do click on that link and get the complimentary access and avail of the calculators and the other videos and other information provided over there. So, just to sum it all up, I do see some questions on the chat box. I will take it up. I'll also take other questions which you all may have, but just to sum it up again, I would like to say first is check your tax liability under both regimes, choose your regime carefully. If you're having business income, you can't do anything, you can't change regimes, but if you're just salaried individuals, you can change tax regimes based on what works better for you. If you're opting for old tax regime, choose the financial products carefully, not just for tax benefits. See the tax, how tax efficient it is. That is basically how the returns are being taxed. So do keep these things in mind and always remember, um, keep your investment proofs with you for at least 7 years. So the minimum time period is 7 years within which you could receive a tax notice asking you to provide the proofs of the investments which you have made. But sometimes there have been cases where a tax notice has been received even after 10 years. So ideally, there is no number of years for which you need to hold. It could be infinity. At least have a soft copy of all your investment proofs. If not, at least for 7 years, please do hold your investment proofs. Do not discard it because any point of time there might be a tax notice. Secondly, just for the sake of providing information, don't give false information. This year, especially, has been the highest number of tax notices which have gone to people. And most often, the reason has been that they have not declared their income properly or they have declared some deductions which have actually not been there, right? So in that case, they have got a tax notice asking them to provide the proof of the investment which they have made. Because, like I said, nowadays everything is being tracked. So if you have told that I have invested under, say, possibly you have declared saying I have invested in PPF 1.5 lakhs, but you have not actually done it. Government would know because your PAN number is required to be investing everywhere. So your annual information statement would have already captured whether you have invested in a PPF or not. If that is not there, then be sure there'll be a tax notice coming up. So please do not just declare something for the sake of declaring. Please do invest properly and then only show declarations, and try not to hide anything from the government. Like I said, each and every move of ours is being tracked. So rather than trying to, find measures where you can evade taxes, it is better to declare everything openly so that there is no complication in the later on days or years. And in case you have received a tax notice, please do respond to it. If you do not know how to respond on your own, then please do take the help of a chartered accountant and respond to the tax notices within time. If you have still not filed your income tax returns for financial year 22-23, last date was 31st July. But if you have still not done it, please go ahead and do it now. Today we are sitting on 21st December. Last date to do it is 31st December. Of course, there's going to be a penalty for belated filing, but at least try to do it before 31st December, because it might not get extended beyond that. So you might not get a chance to file returns for that, and that could lead to a complication in the later years. So please do file your tax returns before 31st December. I'm talking about those who have not yet already filed it before 31st July. So yes, thank you so much for your time. I hope you could get something out of this session. And we have vetted some tax CAs. So basically, if you wish to avail the services, FinSafe is not associated in any way. We do not know the charges. You can check with the auditor in case you are required. We have vetted some CAs. So if you wish to, you can scan the QR code and avail the services of a chartered accountant if you wish to. So I do see some, 1 second. Any questions on the chat box, Bhakti? I'm also just scrolling
Yeah.
through the chat box.
Soumya, so basically we have few questions. Mr. Pratik has asked, what is VPF?
It's Public Provident Fund. It's a scheme by the post office, but you can invest in it by going to any post office or by going to any bank, even your HDFC or your private banks, ICICI, etc. All your private banks also offer Public Provident Fund. It's a scheme of investment where you invest anywhere between 500 to 1.5 lakhs in a year. So minimum that you can need to invest is 500. Maximum 1.5 lakhs in a year you can invest. The money which you invest in this scheme stays locked in for 15 years, which means you can't withdraw for 15 years after you have started investing. Now, at the end of 15 years, so every year basically you're getting returns, you're getting interest at the rate of 7.1%, and the interest is getting compounded. So interest on interest. So your investment for this year, you're getting 7.1%. Next year, are adding more investments. So last year's investment plus returns plus the new investment, you get 7.1% on that. So that's how compounding works. And at the end of 15 years, whatever returns you get back from the scheme is completely tax-free. So that's a PPF scheme, sir.
Mr. Amit has asked, can you please clarify on the lock-in period for PPF and VPF?
Okay. So PPF is, like I said, Public Provident Fund. Lock-in period is 15 years, 1-5. Now, VPF is Voluntary Provident Fund, which means your EPF, which you're already contributing, which is 12% of your basic. If you want to contribute more than 12% of your basic, what you do is go to your employer. There'll be a window again. Most likely it opens in April. So please check with your HR. There'll be a window wherein you can opt for more than 12% of your basic. So you need to go to your HR and say, I wish to invest, say, 20% of my basic or 30% of my basic into EPF instead of mandatory 12%. So the additional amount also goes into the EPF account only. Interest also you get as per the EPF account only. Lock-in is basically 5 years. There is so ideally there is no lock-in. Ideally, you should keep it till your retirement, is what I would suggest. But in case you're withdrawing after 5 years, the returns will be tax-free. If you're withdrawing before 5 years, your interest is going to be taxable.
So if you have any more questions, anyone, you can drop in the chat box and we'll take it up.
Okay, there's one question from Samir. For LTA, every travel money is allowed or only 2 times one claim? So twice in a block of 4 years. So within from 22 to 26, 2 times you can travel and claim. I mean, you can travel 5 times also, but you can claim twice for 4 years. For LTA, all the bills, that is air travel, etc., need to be in a sequence, or can it be from random months in the financial year? Technically, it can be in random months, but like I said, please do check with your HR because they are the ones who is going to be deducting the taxes on your LTA amount. So please check with your HR on the rules and regulations for that. And like I said, there might be a certain number of days which you compulsorily need to show as leave to be able to claim the HRA, to be able to claim the LTA. So please do check on that as well.
Hi, can we speak? We can speak, no?
Yes.
Yes,
Okay.
definitely.
Yeah, for this leave travel elements, no? So whatever the tickets, like flight tickets or train tickets, these tickets need to be in the same month or something like that, or in the entire year it can be random months, no?
That's what I said, sir. It can be random months in the entire year.
Entire
But
year. Okay, in the
please,
block
once,
it's okay.
yes, but please check with your HR because they might have some. See, each company might have their own set of rules and regulations when it comes to claiming LTA. That's all
And
I'm
for,
trying to say.
yeah, and for flights, we need to show the boarding pass and all, or the tax invoice is fine.
I think the tax invoice should be sufficient.
Okay, and for this SSY, this 1.5 lakhs under ATC, what kind of documents we need to submit?
So you'll have a passbook, like a PPF also comes with a passbook. Your Sukanya Samriddhi Yojana will also have a passbook. So you can show the first page of that, which has your name.
The amount transactions no need to show, right?
It would be yeah, it is better that you show. Otherwise, how will they know how much you have contributed?
Yeah. So then we need to, because I have a passbook. The point is like there is no transactions recorded in that passbook because we used to do directly through UPI.
So possibly your bank account statement, which shows a transfer to that particular SSY account, could also serve as proof.
Okay, I'll check.
So we have another question. If an employee is moving to own home, joint name of employee and wife in mid of the year, how is the HRA or tax computed?
So HRA till the time you have stayed in the rented accommodation, and once you have moved out or moved to your own accommodation, then the HRA stops. Basically, you cannot claim HRA benefits.
Another question. Who are eligible for Rajiv Gandhi Equity Scheme?
I am not really very sure about this one. I'll have to come back to you. I'll drop my mail ID. Janardhan, you can write into me and I will get back to you on this question. I'm not really sure about the Rajiv Gandhi Equity Scheme.
One more question under 80G donations. Is there any maximum fund that is allotted to that?
No.
It's an indefinite.
It is percentage of your donation. So like I said, a Prime Minister Relief Fund is 100%. So even if I have donated 5 lakhs, the entire 5 lakhs is tax exempt.
Okay, got it. Thanks.
Yeah. So I do see a poll which has come up. Please do answer the poll questions. In the meanwhile, I see 2 more questions on the chat box, Bhakti. Let's say we have invested in NSC last year. Shall we be able to declare it this year? No, last year's contribution is last year's tax exemption. You have already claimed. This year, if you have made a fresh contribution, then you can claim that under Section 80C. If not, no.
Thanks, Soumya.
Thank you. I got a message here. If an employee is moving, okay, I think I've answered that. Section 80C and 24B. 1.5 lakhs plus 2 lakhs is 3.5 lakhs, or maximum is 2 lakhs. No, it is 3.5 lakhs. So if your principal is 1.5 lakhs, or if your other EPF plus home loan principal, etc., 1.5 lakhs you can claim, plus 2 lakhs interest on your home loan is maximum that you can claim. So totally, yes, 3.5 lakhs. If your principal is 1.5 lakhs and if your interest is 2 lakhs, then totally you can claim 3.5 lakhs on your home loan. I hope I'm clear on that. I hope there's no confusion, Amit. If you want, you can voice out if I'm not clear in my answer.
No, sir, that helped because I had that question on this ATC and 24B, right, with respect to this principal and the interest rate, right? So
Yeah.
I'll just maybe check on
Principal
like how.
falls under ATC. It's 1.5 lakhs, including all other ATC things.
Okay.
Don't mistake it. So 1.5 lakhs of home loan principal plus ATC you cannot claim separately.
It is
But
one
2
of it
lakhs of
actually.
interest you can completely claim.
I have a doubt in vehicle car allowance. We can ask that thing as well.
Vehicle, it's an allowance. It's not under any section that you can claim. So it completely depends on your company how they are giving it to you. Yeah, so it's a deduction from your, it's an allowance basically, which gets calculated through your company itself. It's not something which you can show in your ITR and claim separately. LTA again is not a section which you can claim. It is an allowance. So how you claim it is, if you provide the proofs to your employer, they will give you tax benefit. If you're not providing any proofs, they will assume you have not traveled and your entire LTA amount will be taxable as per your tax law. I think I have more or less, I don't see any more questions.
Yeah, so if
I
anyone
have one question.
okay, please go ahead.
Yeah, let's say that for ATC, the amount is 1.5 lakh, right? And if if we have invested in mutual fund and the amount is exceeded, then how much receipt or what we have to declare?
No,
Like the amount is
if you have
exceeded.
invested in mutual fund, in the sense you're saying ELSS mutual fund?
Yes, yes, ELS mutual fund, but the amount is exceeded like more than like it's 2 lakh. So what should I declare?
You can show the proof of your 2 lakh investment, but you will be able to claim only 1.5 lakhs. The
Okay,
remaining
okay,
50,000, you won't get a benefit on it.
okay, got it.